So I was able to get commercial debt on that property and refinance out my 10%, paid him off completely, had my cash back, and was amazed because that was my entire strategy in single family. It's like, how fast can I create value here? Then I can recycle that value into another investment. So we did that on the scale of multifamily and continued to look for more opportunities to do so. So that's where I found my niche.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Ross Hubbard started with his first real estate investment in 2010. To today, he's managing a portfolio of over 1,500 units. Ross, welcome to the show.
Thanks, Sam. Appreciate having me.
Absolutely, Ross. There are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start, where are you now, and how did you get there?
Sure. Yeah, I started out, honestly, I wasn't even considering getting into real estate. I owned a condo at the time, just got fresh out of college, was working for my parents as a painting contractor, expecting to take that business over. That was my goal and my ambition. My wife and I had moved just downtown Kirkland in the Seattle area, and we started, I was listening to the radio one day and ended up hearing an ad from an auction company saying, come into the auction, we can represent you, give you the hard money loan, you'll buy a house, you'll rent it out, you'll make $300 passive income a month for $0 down. So I was pretty skeptical, but I went to the Thursday night meeting, and about 6 weeks later, we ended up buying our first little auction property in SeaTac, Washington.
Just out of pure curiosity, was the ad actually true? Did they end up doing the hard money loan, or was that just our version of or the then version of clickbait?
Yeah, no, it was real. So in 2010, hard money was at 12% and 4 points still, and there was several companies in this area that were doing it. I worked with the company that represented at auction and then provided a resource as a lender to provide the hard money loan for getting that property taken down. And even then property management on top of that. So like kind of a one-stop shop. And I really liked that feel. Part of the hard thing I had to deal with was just determining what was real, what was a good deal, what was not, what was going to end up making me money, and what was going to end up costing me money. So I took a lot of time to develop my own tool to understand, conservatively where I was going to go based upon actual data the market was experiencing, rather than lofty pro forma goals that may or may not be hit.
Right. And if only you could rewind, I bet you would tell yourself today to buy everything that you looked at and quit underwriting it.
Yeah, certainly. Yeah, no, that's absolutely the case. And how could I have known? I did try to do more than what I could afford to do at the time. But at the time, there was really difficult to get access to unique credit. There was hard money that was asset based, but other than that, conventional lending standards very tight. So you had to do everything the right way after the 2008 financial crisis, which has been a blessing for what we're going through today in terms of the real estate market and how healthy it is right now. Right.
No, absolutely. And those are the defining characteristics between a speculator and an investor. I mean, none of us would have known, in 2010, or in my case, when I got in 2013, just to hit the buy button on everything and forget about worrying about what it's going to be, what I think it's going to be worth. But again, that's just pure speculation. So it is always fun, though, to go back and kind of look at that and go, wow, I passed on that for that.
Certainly, yeah.
We're giving it away, but that's that's the nature of the beast. When did you make the transition to multifamily and/or commercial real estate?
My first multifamily deal was in 2015. I had shifted out of painting in 2014. I fall off a ladder from 18 feet and decided that wasn't going to be for me anymore, which forced me to have that inflection point where I changed careers and just jumped into real estate as a professional. So I started to help other people do what I was doing for myself, which is buying investment property and doing so in a very methodical and systematic way. So I gained a pretty decent following of people that wanted to continue to work with me, and became a real estate broker, got into the business of brokering, continuing to buy for myself. That again stressed me because I was a 2-year dead to the banks, 1099, no W-2. So I had to figure out, how I could invest. So I went across and looked at old deals, tried to engage people that had owned a long time property so I could have them sell or finance. So in 2015, I got into my first apartment deal, 19 units, and was able to get into it for only 10% down. And had a relationship with the seller that developed from me meeting him, and kind of hit it off and told him what I wanted to do. And he seemed to trust me and believe in me. And a year and a half later, I refinanced out of that debt, At that point, I had a little over 2 years of 1099 income that justified my existence. So I was able to get commercial debt on that property and refinance out my 10%, paid him off completely, had my cash back, and was amazed because that was my entire strategy in single family. It's like, how fast can I create value here? Then I can recycle that value into another investment. So we did that on the scale of multifamily and continued to look for more opportunities to do so. So that's where I found my niche.
Got it. And so you just kept acquiring, recycling that value. Is that a strategy that you feel like is viable in today's lending environment?
Only if you buy right. So it really depends entirely upon what type of inventory you're shopping for. If you're an average Joe and you're looking on the MLS or you're looking on commercial websites to find your real estate, then probably not, and hasn't been able to work for, 8 years. But if you're looking direct to seller, wholesaler, broker relationships that are off market in nature, which is what I spent 2015 to present developing, then you're able to buy at a discount because we're looking at properties that have severely underweight NOI. The rents aren't high enough. Operational efficiency is really bad. There's deferred maintenance. So now I can go and approach that seller, understanding that the market value of that property is much less than it could be, and looking for the value add opportunity. We also stepped into asset class conversions, which are really unique. So we're able to take something like a hotel and convert it into an apartment, which entirely changes the financial perception of the asset because the apartment building is much more secure. That's a very good way to create a value add equity play, allow yourself to get into a position where you can continue that strategy of burning out of something, refinancing after renovating, and continuing to repeat that cycle. But of course, along the way, we've injected new capital. Very excited about what we're doing and constantly looking to continue to increase our passive investment ability to earn so that eventually the active can become substantially less.
So there's so much to unpack in everything you just said. Buying at a discount, I would, or not make the assumption, but certainly hear more often than not that anything that's worth buying is probably already been either forced appreciated, the value add has already been done. How are you finding assets that even today are still poorly managed, not picked over, not already had somebody else come in and done exactly what you want to do?
Well, it takes a long time to build the relationships out. So since 2015, when we really started intentionally going after multifamily value add assets, picked a few criteria, some 2% rules and target markets to dive deep into. Then I started to recruit other people. So using my ability to show, here's what I made in real estate last year on 1099. Why don't you come and do this for me? This is what we're looking for. You eat what you kill. So you bring it to me, I'm going to buy it. And then if it looks good, at least, of course. And we're just going to turn over as much inventory as we can. There is a lot of real estate in the United States of America. In our target markets, there are 7 states in total that we're going after. And we're really hitting it hard. So that allows us to turn up, from title lists, direct to seller, wholesaler, broker connections, a lot of options to look at. And a lot of people use a rule of thumb for one property you get under contract on and close on, probably looked at 200 deals. That's very accurate. It's just you're sifting through a lot of garbage, a lot of people that don't have the right sales price expectations, their values not substantiated by their NOI against the market cap rate, and are looking to sell it for a higher price than what it's worth. But we're just not that buyer. So the combination of the diligent looking and then patience and understanding that we know what our numbers are going to dictate in terms of the sales value of that property. So I'm going to present that and then I'm going to wait. What often happens is that the seller will engage with other buyers that will just give them what they want up front, then try to retrade. And there I am, just Mr. Consistent, holding the same bag of money offered in the beginning. When the seller comes back and says it didn't work out, the transaction failed, are you still interested?
What's it been like? I mean, that's an entire process in business in and of itself of having the deal sent to you, however it is that you set up those relationships, whether that's with a wholesaler, whether that's with a broker, or whether it's your own direct to seller leads that you've generated, to bringing that across your desk, reviewing the deal, and then putting it in some sort of follow-up CRM system where you say, oh, wait, you offered on this, and then circling back in 30 days. I mean, that's a lot to keep up with. Tell me about that system And what are some keys, I guess, that you've found to really making that thing work?
We've used several CRM systems over the years, but I think the key has always been in the individual. So some of the best people that are procuring property out there, I call them my acquisition specialists. They're looking for exactly what I want to buy, and they're only bringing me what meets my criteria. So they have systems that are built in for themselves. So what I've leveraged on is not a specific system that I created and that I've implemented and allowed everybody else to use. I've leveraged other people's. So they have their own unique way of interacting, keeping track of their people and trying to engage sellers to sell. And once it rises to the top, I'm looking at it to make that ultimate decision about whether to acquire or take the next step. But in the middle, they're taking all that workload on just to get to the end where they can close on something with me and get paid. But the organization and the system of it is widely up to them. For the start, I really did focus on trying to create my own wheel, but I realized it just wasn't fast enough, and I could do a lot more with other people that had already done the same thing, not recreating what they have already created, and being able to build and expand upon that. Just simply offering them a resource that they knew would buy as long as the criteria was met.
Right. And so I understand, obviously, working directly to seller, like that's a method we've certainly employed. I understand working with brokers. Working with wholesalers, though, inside of the multifamily space has got to have some nuance to it. Am I right in saying that?
It's got a lot of nuance, and it's hard to understand who actually has the right to purchase the property. It can get daisy chained 3 or 4 times and have hundreds of thousands of dollars of commission paid to a wholesaler, assignment fee paid to a wholesaler as part of the deal that makes the deal impossible. So it certainly does depend. It doesn't always work out, but they're a valuable resource because they are doing a lot of hard work out there and ultimately bringing things to sale that are not otherwise available.
How do you know when you're dealing with a professional in the wholesaling space or just another hack? Because there's plenty of hacks that are just, and again, it got to the point in the single family space back when I used to do single family, where it was just like, just don't send me anything else because if it's just so much of it's garbage. How do you filter through that?
Quick filters that I teach all my guys and gals is the rules of thumb. Simple things you need to pay attention to. Most folks have heard about the 1% rule. For every $100,000 that you purchase a unit for, you have to have $1,000 in gross rent a month in order to meet that rule. So that's a simple standard. Then plugging it into underwriting and going a little bit deeper into analysis after hitting a few of those rules will allow us to see if the math is making sense. And if it does, then we're going to pursue it. Once we start to work with the wholesaler and engage them, we're always making a property visit, which is the fun part because the wholesaler is not going to spend the money to get there. So we're going to meet directly with the seller. And that's when we start unpacking a lot of things that we didn't know about because that weren't disclosed to us from the wholesaler, either from them not knowing or them not wanting to say, which includes assignment fees and what the seller is getting out of the deal and things of that nature. That gives a lot of leverage. I don't want to shortcut anybody. Everybody gets paid. And the more that you bring me in, the more that is valuable, the more that I pay you. But ultimately, it's all got to make sense for the deal. The seller has to be on board. The wholesaler has to be on board. Everybody gets a fair shake that way.
Got it. No, that's really cool. Thanks for unpacking that for us. Tell me about asset class conversions. Lots of questions on that front, but maybe if you can just tell me about a deal that you guys did, and how you found it. What were the keys to making it an effective, the business plan, getting the business plan actually, worked out and make it an effective investment. And then love to hear financing on that as well.
Yeah, sure. So one of the first hotel asset class conversions that we did was operating only as a partial hotel. So it was a kind of a light step into the space. So half of it was already operating as an apartment. The other half was nightly, weekly. So we simply changed that. When we bought it, we got conventional financing, construction loan financing. Bear in mind, this was 2019. So fairly attainable. And we were able to get that property fully kitchened out. So we put in full-size kitchens, renovate the bathroom, renovate the units, and renovate the entire community to make it really appealing. We love young professionals as a general demographic to target in almost any market that we're buying in because they're underserved. They're often provided housing that is not nice enough. They're not able to afford the A-class young working class professionals, but they can't stand living in a C class that looks like a turd either. So they really want something in the middle. So how do you find that and still make a margin on it? So the whole asset class conversions was really interesting because it allowed us to undercut the market a bit. We're renting out studio units, and we weren't quite sure how that was going to go. So undercutting the market, getting full occupancy, and then starting to stress that market's potential was what we found to be very successful. And that proved the pudding for us. We were able to understand that there is a severe demand for studio housing, and there is a very limited supply of it. They didn't used to build studios because it was relatively inexpensive to build. Now that it's very expensive to build, they're building micro apartments. But one thing about those micro apartments is that they're downtown core. You're usually sharing a bathroom. You're usually sharing a kitchen, and it's still very expensive because they're A-class and they're amenitized and they're in a downtown corridor. So it's been cool to find something that is very much in demand and then continue to press that.
That's an interesting point where you said and what I hear is that it's not an A-class property and it's not amenitized. So the tenant isn't ending up paying for features maybe that they either A, can't afford, or B, don't want. Is that right?
Yeah, we bring them up to a solid B+, but it's hard to take a 1954 building and make it an A-class building. It's going to be always kind of reminiscent of that era of architecture and construction. That was what that property happened to be, but is well amenitized. We have a yoga studio, we have a workout room, we have a pool house, we have a pool, we have a pool hall, we have a lounge, and so there's a lot of things that it offers still. It's just not as fancy.
And you said that you're able to undercut the market. Is that, you're just able to bring rents down. It's basically your own version of affordable housing.
Yeah, it very much is. And it's a huge benefit for the market that we're entering, but also for us because we can expect high occupancy. Right. So within a 6-month timeline of getting to the point where we're renovated and ready to lease, we were 99.6% on 175 units. So only having that model unit open still. And I was shocked. And then following year, we increased rents relative to what the market was showing us, which happened to be a 22% increase. So we went ahead and did that. And we lost about 12%. And then we filled it up again within 2 months. So there's market demand is such that it just supported that and allowed us to continue to do it at a really reasonable pace while still providing the market something that was desired. And because of the limited square footage, it's still relatively affordable. It's independent living. It's your own place. It's your own kitchen, your own bathroom. You're paying less than $1,000 a month for it. How do you do that these days?
Yeah, you really don't. You really don't. What are the considerations, from exterior access? Are they interior access? Hallways. Is there a certain type that works and a certain type that doesn't?
Yeah, sure. There's some debate on that. I think it's just an opinion issue, really. For me, I spent enough time, I guess, in residential that I grew to not like the interior corridor, primarily with condominiums. So I look for exterior only. It's a couple of simple reasons. I don't generally want to smell what other people are cooking. And then the second being that we don't have exterior access. If these hotels are traditional hotels, which they often are, 1980s, 1990s builds, they don't have balconies, they don't have decks. So you're going to need to provide better access to the outside for people, and it'll keep your building cleaner. If you've got a place that there's a designated smoking area, they can leave and go do that without too much pain because it's an exterior corridor entry. So that's why I focus on those.
Got it. And why are these hotels coming up for sale? Why aren't they making it as a hotel?
Well, hotels are difficult to sell. I think generally speaking, hoteliers are a unique breed of folks that have definitely spent the time building out their hotels and managing them and operating them, but it's not for everybody. For a hotel, you're going to be running between 60 and 70% expense ratio. You're going to have 24 hours, 7 days a week staff, and you're going to have all the fun that comes with 24 hours, 7 day a week staff. People get sick, have families, et cetera. So it's a lot to manage. Because of that, it just demands a lesser price per unit, a lesser price on GRM and cap rate. And as a hotel that's not converted yet, we can still buy it as a hotel. So coming out of 2020, it's been really interesting because they had a significant uptick in hotel rentals for a while. The revenue was very high, and then it crashed. The free money stopped being printed. There were things that were not going well any longer in local economies that were not aligned them to support, people paying for these units on a nightly basis. So they started to decline in total revenue, which makes their value go down. So there I enter the picture and solve a problem really for the seller, which is that their revenue's down. They want out of the business and they want to liquidate for as much as they can. Now, a typical hotelier is probably going to look at that property and go, I'm going to pay like 3 or 4 GRM. Like, this is a bad property. But I am still in that 4 to 5 GRM because I know I'm going to take it to double that total value. Or whatever I'm buying it for, with a modest amount of renovation, we're going to turn it into an apartment building that is going to sell at a 10 to 12 GRM.
Right. Now that's really, really cool. Thank you for taking the time to explain that. When it comes to the construction side of things, I mean, adding kitchens into a typical hotel room size, I mean, that's got to be a micro kitchen, I would imagine, pretty compact. But then are there complications on the construction side when doing that?
Yes, I think this is the most difficult part. It's probably the biggest area of pitfall for a few reasons. Labor is impossible to find now. It's very expensive.
Right.
Materials are very expensive, although they have been going in the right direction over the past few months. So it's an area where you can really misstep, and it costs you a lot of money, especially if you don't know what you're doing. Thankfully, with the experience that we have in general contracting, the resources that I have in general contracting still, most of the people that I employ are invested with me. And so they're already fully knees deep into the whole thing. Their interests are aligned, and they're making these projects the most efficient they can be. They know that the profit and overhead that they're covering right now is only a part of the pie. Their equity position is what they're really interested in. So they're looking for a better opportunity to expand their potential, and therefore I get really good values on my renovations. We also stay ahead of supply chain issues. We do a lot of warehousing. We do a lot of cost storage boxes so that we can get materials on site. We don't need delay like that. We don't need costs going up just because time is passing. When we know that our project is going to require a 200 unit overhaul, let's go ahead and get those 200 unit worth of stuff, put it on site securely so that we can depend upon it and not have the prices change on us.
Right. No, that's really, really interesting. I love that. And is that one of your strategies moving forward, or is that your main strategy now?
No, we have 3 verticals. So we're focused on value add repositions, but like you highlighted, it's very difficult to find those. Then, of course, asset class conversions are a big opportunity for us. So we're continuing to pound those hard and looking forward to more. But then storage units, another area that's difficult to enter and difficult to find deals that are acquirable. We're getting to that space in more tertiary markets right now that are going to be very good cash flows. But we're designed in a unique way where we're designed to balance, where we have cash flow as a part of the emphasis because we're paying out a quarterly dividend to our investors. And then, of course, appreciation. Now, how do we get your dollar to pop as much as possible over a fixed period of investment time? So we're targeting a really aggressive equity multiplier as a result of our fairly innovative way to value add and then reuse the capital. So we're doing the Burr model essentially at scale with a pool of investors that are primarily friends and family, but we do have several outside as well. And we've been doing that since 2016. I started intentionally organizing partnerships, but since then we merged into the group Sage Investment Group, which is our company that we co-founded and manages about 23 apartment total different properties right now across 1,400 units in 7 states.
That's fantastic. Ross, thank you for taking the time to come on the show today. I certainly appreciate it. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Yeah, certainly. So sageinvestment.group is our website, sageinvestment.group. And you can check us out there. Contact goes directly to my wife, Emily Hubbard. Definitely a family business. We are 13 strong. So we've got office here in Kirkland and over in Richland in the state of Washington. But would be happy to talk to you, understand what your real estate investing goals may be, and help you learn more about how you can achieve those.
Fantastic. Ross, thanks so much. Appreciate it. Have a great rest of your day.
Thank you, Sam.